I'm going to ask you, as a real estate practitioner,
Hmm.
because you and I both know a lot of real estate practitioners,
Right.
both in sales, in title, in loan, brokers, whatever the case may be, investors. If they are to effectively utilize a tax advantage retirement account
Hmm.
or other tax strategies as those real estate practitioners, which ones should they be looking at? Should they be looking at SEP IRAs? Should they be looking at individual 401ks? What is it that should they be looking at, and how soon should they be investing in those or putting money, that 20% or more, into those accounts?
Okay. So there are three, I like to call them buckets,
Okay.
that people can put money in to build assets when we're talking about tax consequences.
Okay.
All right. So the first one is what I like to call a taxable bucket. All that means is you've generated some income, you've paid taxes on the income, and then you took the after tax dollars and put it in whatever asset lives in the taxable bucket. All right. It's a double tax bucket though, Carlton, because
Right.
if that asset grows, sometimes at the end of the year, you'll get a 1099 from our favorite Uncle Samuel, and you
Right.
got to pay a second tax. Or if it's an asset that's in the taxable bucket and you've grown it and let it gain in value, when you sell it, you have to pay what we call capital gains taxes.
Mm-hmm.
Right. So
Mm-hmm.
just to be clear, the things that live in that first bucket, that taxable bucket, checking account, saving account, money market account, certificate of deposits, they have interest rates. Interest rates are now going back up again. And so that means at the end of the year, your money will make some money and you owe another tax bill.
Right.
I don't want to put our age out there, but you and I share something in common with being, former United States Marines. And I'll tell you, when I was in the Marine Corps, the interest rate on my Navy Federal Credit Union account was 16%.
Yeah.
So when I got a 1099 at the end of the year, it scared me blind because I was an 18-year-old dude from the inner city of DC, and I did not know what a 1099 was, but I had heard about this IRS. And so when I got a letter from them, bro, I was like, oh my God, I'm going to jail.
Exactly.
Right?
Exactly.
I had no
Exactly.
idea what it meant. And my sergeant laughed at me and said, no, son, this means that your money was saved and it made money. I'm like,
Yeah.
oh, okay. But that's what's in that taxable bucket. We don't have to worry about that so much now because the interest rates aren't double digits, but they may
Right.
get there soon.
Yeah.
The second bucket is called a tax deferred bucket. That's the
Okay.
technical name. I like to call it tax postpone.
Okay.
So this is where you can make money, and before you pay taxes on the money, you can drop it in this bucket. Things like 401ks, IRAs, SEPs, simples, all of those things,
Yeah.
right? So when you put the money in, you don't pay any taxes. The money can grow for years and you still don't pay any taxes. You don't pay any taxes on this money until you get into retirement and you pull it out. Then you have to pay ordinary income tax rates,
Mm-hmm.
whatever the rates are going to be in the future. And then the last bucket is your tax free bucket. And the
Okay.
tax free portion of this bucket is the tax free on the growth and the distribution. So you have to make money, pay taxes on the money with after tax dollars put in the bucket, just like the first one. The
Yeah.
difference is it grows without taxes and you can spend it or give it away without taxes. So those are
Right.
your three buckets. So now that you understand the buckets, typically what works best is if everybody has some assets across all
All
three.
buckets. Yeah.
All right. So, but again, as individual as people are that are watching this, we have to do the analysis to see what makes the most sense for you. Because here are the variables you have to look at. How much time do I have to fill these buckets?
Right.
How much money am I going to need from any one of or a couple of these buckets when I do get to retirement? The money that I want to use to accomplish my legacy objective, what when I pass it on, what's going to be the tax ramification to my heirs or to my estate? Right. So it goes back to my self-serving statement, but it's just true. If you're not doing some sort of planning, I don't know how you get the answers to these questions. I don't know how you become successful. I
Mm-hmm.
just don't know because it's so much, there's so many moving parts.